Welcome back to A Stitch in Tax Saves Cash, the channel where we simplify Nigerian tax laws for business owners, tax professionals, and everyday taxpayers. Today, we are breaking down one of the most powerful provisions in the Nigeria Tax Act 2025, a chargeability to tax under Section 5. If you want to understand who can be taxed, how the government enforces tax liability, and what has changed under the new consolidated tax regime, this video is for you. Section 5 of the Nigeria Tax Act 2025 answers a very important question: in whose name can the government impose a tax? This might sound simple, but it's a game changer. Under the old tax laws, the rules for companies were in the Companies Income Tax Act, or CITA, and the rules for individuals were in the Personal Income Tax Act, or PITA. It was scattered and sometimes confusing. Now, everything has been merged into one unified rule, making tax administration much more efficient and closing several loopholes that businesses used to exploit. This consolidation is a big deal because it brings clarity and consistency, which is exactly what you need when dealing with something as crucial as taxes. So, what's the big idea behind this provision? It's all about practicality. Tax law isn't just about identifying what income is taxable, it's about ensuring there is always someone responsible for paying the tax. Think of it this way: tax liability is sticky. It attaches itself to the income, and the government needs a person or an entity to hold accountable. So, even if a taxpayer dies, relocates abroad, or a company goes into liquidation, the tax liability doesn't just vanish into thin air. There must be someone the revenue, like the FIRS, can look to for payment. This section ensures that tax obligations don't get lost in legal complexities or life events. It's designed to make sure that for every naira of taxable income, there's a corresponding person or entity responsible for remitting the tax due. This principle is the backbone of an effective tax system. Let's first look at how Section 5 works for companies. The starting point is straightforward: a company is assessed in its own name. This makes sense because, in the eyes of the law, a company is a legal person, separate from its owners or directors. It can sue, be sued, and of course, it can be taxed. However, the new law goes much further than this. What happens if the company is foreign and doesn't have a physical office here? What if it's been dissolved? Or what if it's hiding behind agents to do business in Nigeria? Section 5 gives the tax authorities the power to impose the tax in the name of several other parties. This could be the principal officer of the company, like the CEO or managing director. It could be an agent acting on behalf of the company in Nigeria, an attorney, or any other representative. In cases of insolvency or liquidation, the tax can be assessed in the name of the receiver or liquidator. What this means is that companies, especially foreign firms, can no longer escape their tax obligations by shifting operations offshore, using complex agency structures, or simply dissolving the local entity. The net has been cast much wider to catch them. Now, let's talk about how this works for individuals. Just like with companies, individuals are primarily assessed and taxed in their own name. That's the default. You earn income, you pay tax on it. But what happens when an individual is not around to handle their tax affairs? For instance, what if they are absent from the country for a long period, are incapacitated, or have passed away? The Act allows the tax assessment to be made in the name of a representative. This can be a family, especially in cases of community income. It can be a trustee who manages a trust fund. It can be an executor or an administrator who is responsible for a deceased person's estate. Or it could be an attorney or agent who manages the individual's financial affairs. So, income generated by an estate, like rent from inherited properties or income from a trust fund, is all still taxable. The law ensures that someone, whether it's the administrator, trustee, or agent, is legally responsible for filing the returns and paying the tax on that income. There's no escaping tax, even after death. So, what is the real legal and practical impact of all this? First, it establishes the continuity of liability. Tax obligations don't just disappear. They survive death, liquidation, or relocation. If you owe tax, your estate will still owe it. If a company dissolves, its tax liabilities must be settled. Second, it creates what we call representative liability. This is crucial. Agents, trustees, and administrators can be held personally responsible if they receive income on behalf of someone else but fail to remit the tax due. They can't just say, "Oh, it wasn't my money." The law makes them accountable. Third, this section is a powerful anti-avoidance tool. You can't avoid tax simply by dissolving your company, using proxies to conduct business, or shifting your operations abroad. The tax authorities now have a clear legal basis to go after the representative in Nigeria. And finally, this brings Nigeria's tax system more in line with global best practices. This concept of representative assessment is a standard feature in the tax systems of countries like the UK, the US, India, and across the OECD. It's a sign of a maturing and robust tax administration. To really appreciate the change, let's compare the old laws with the new Nigeria Tax Act 2025. Under the old system, you had to jump between different laws. The rules for companies were in Section 47 of SIDA. The rules for individuals, families, and trusts were in Section 40 of PITA. Each had its own specific language and nuances. This created complexity and, at times, inconsistency. A tax professional would need to be an expert in both acts to advise a client properly. Now, the Nigeria Tax Act 2025 merges everything into one consolidated framework under Section 5. This makes the law much easier to understand, interpret, and apply for everyone from tax officials to business owners. This single, unified provision promotes clarity and removes any ambiguity about who is responsible for paying tax in various situations. It's a significant step towards simplification and efficiency. Let's use some real-life examples to make this even clearer. Imagine a company based in the UK that sells its products in Nigeria through a local distributor. The UK company has no office here and argues it's not a Nigerian company, so it refuses to file tax returns. Under Section 5 of the new Act, the FIRS can now directly assess the local distributor for the taxes due on the profits from those sales. The distributor becomes the representative, and the FIRS doesn't have to chase the company all the way to the UK. Here's another example for individuals. Let's say Mr. Adebayo passes away, leaving behind a rental building in Lagos. His children appoint an administrator to manage his estate. That rental income doesn't suddenly become tax-free. The estate administrator has a legal duty to collect the rent, file tax returns on behalf of the estate, and pay the taxes due on that income. If they fail to do so, the tax authority can hold the administrator personally liable for the unpaid tax. These examples show how Section 5 works in practice to ensure tax is paid. So, what does this all mean for you, whether you're running a business or advising one? First, if you are a company using agents or representatives in Nigeria, you must ensure they are tax compliant. Their actions or inactions can create a tax liability for you and for them. Second, if you are an administrator of an estate or a trustee, you have a legal responsibility to file returns and pay taxes correctly. Ignorance of this duty is not an excuse. Third, for foreign companies looking to do business in Nigeria, it is now more important than ever to have proper Nigerian tax management and advisory services. You cannot operate through a representative and assume you are shielded from tax. And finally, for my fellow tax professionals, this is a critical area to advise your clients on. You need to explain the risks and responsibilities of representative liability to prevent them from getting into trouble with the tax authorities. To wrap it up, Section 5 of the Nigeria Tax Act 2025 is a major enforcement tool for the government. It simplifies tax compliance and powerfully reinforces the principle that tax follows income, no matter the legal structure or circumstances behind it. It closes loopholes and ensures a level playing field for everyone. I hope this breakdown has been helpful for you. If you found this video valuable, please give it a thumbs up, drop a comment below with your questions or thoughts, and share it with your network of friends and colleagues who might benefit. And of course, Don't forget to subscribe for more deep dive content on Nigerian tax law. I am Olatunji Abdulrazak, founder and CEO of TaxMobile.online. Remember, a stitch in tax saves cash. Thank you for watching, and I'll see you in the next video.